Let's look at this 2020 market crash from a different perspective, from a volatility perspective. Because, we're analyzing this thing from every which way, trying to figure out what might happen. And now it's time for vol. And lucky for us, we got one of the best volatility traders in the game right at Macro Ops, Tyler. You guys remember Tyler, right? He's made a bunch of videos on the channel. And he's been loving these markets because he's been making an absolute killing on his vol trading. I wish I knew how to do what he was doing, but the guy is so busy nowadays, I can't even get a text back. No response. I mean, when you send someone nudes, at least you could get like a smiley face back or something, some acknowledgement. Quarantine is tough. But he did write this analysis right here, which we are going to go over, which for some reason is in a Google Doc because he didn't publish it on our website. But that's okay. I'll take whatever communication I can get out of him. And before we get into it, just a reminder, NASDAQ All-Stars is open. It's our trading system, and it's only open till Sunday. So click the link down below in the description and comments to check it out. You guys know I talk about the All-Stars all the time and how important it is in a market crash scenario like we're in right now. So yeah, time to get on that if you haven't gotten on it already. Learn more with those links. But okay, let's get into Tyler's analysis. So he says one of the most robust indicators for excellent forward returns in the market is the collective psychology of the masses. Maximum terror is what signals market bottoms, and maximum greed is the top. And you guys know that. We talk about sentiment all the time in our market reviews. So a way to look at it is that extreme fear is excellent expected forward returns. You can expect that the market is going to do real well in the future, long-term future, not immediate. And extreme greed means bad forward returns. Again, long-term, not necessarily short-term. So taking the other side of the emotion is one of the most powerful and profitable investing techniques you can deploy. And you guys know it always goes back to the Buffett saying, be fearful when others are greedy and greedy when others are fearful. Sounds so simple, but like, how do you actually do it? How do you know? Well, VIX, the volatility index, actually helps us with that exact problem, as you'll see. So Tyler says we've officially reached an extreme state of fear in the financial markets. So again, I was saying, how do you know? Well, this isn't his subjective opinion. It's objective based off the VIX, which is a quantitative measure. Here's an example of the VIX chart, and we'll go into it in more depth in a second. So the VIX basically measures the expensiveness of put options in the S&P. And you guys know puts, right? They're basically insurance on the stock market. So you buy a put and you're buying the right to sell a stock at a high price, and you're betting that the stock is going to go lower. So if you're buying a put, you're paying a premium for downside protection. And the premium, how much you got to pay for that insurance, changes depending on supply and demand in the market, obviously, just like everything. And that supply and demand is based off psychology, fear. So the idea is that the higher the VIX is, the more expensive these put options are, which means more people are trying to buy them, which means more fear. More people want insurance of the market going lower. That's how the VIX index works. So last week, the VIX hit an intra-week high of 77.5. And as I'm making this video, it actually almost hit 80. And the higher the number, the more fear, right? And this signals extreme fear. The last time the VIX traded at these levels was in the subprime crisis of 2008. You can see it right here with this line. We're hitting those levels. And back then, if you were able to buy at the right time, well, you made a killing on the way back up. That's how every crisis is, right? Well, the same thing can happen right now. So what we're going to do right now is look at 2008 and use it as an analog for what might happen now. History doesn't repeat itself. It's not going to be exactly the same, but it does rhyme. It is still helpful to use the past data as a guide. So on March 12th is when our VIX closed in the 70s for the first time. So the same thing happened in the Great Financial Crisis on October 10th, 2008. You can see that right here. We hit VIX 70s. And on that day, the S&P traded down to the 880 level, which is right here. But that wasn't the low. The low was all the way down here. The market actually declined another 20% after VIX was already at 70. And this was 6 months later, after we printed that 70 VIX, did the bottom actually form. So if we take that analog and apply it to today, then the spike lower that we had in the S&P when VIX hit 70, that was probably the start of the bottoming process. So the bottoming formation should form over the next 3 to 6 months. But again, this isn't the ultimate low, because what happened last time is that we went sideways for a while and then dropped down another 20%. So Tyler says it's the beginning of a great buying opportunity because we don't get VIX 70 often. This is rare. This is a true crisis. This picture right here is an estimate for what Tyler thinks could happen. We get a nice little rally higher and kind of dip down lower, go sideways a bit, and then make that final leg down before a true bottom is in place. And remember, the market leads economic data. So we're going to see the stock market turn around before the general economy prints better data numbers. So my messages have been blowing up lately. negatively from everybody except Tyler, as I've explained. But everyone's been asking me, AK, how do I invest my money? Because I know right now is a good time. What stocks do I buy? What do I do? Now, I'm obviously biased here, but my response is to invest that money in a good strategy or system so that you're actually safe and protected. Maybe I got a one-track mind, but it's literally the only thing that makes sense to me. These might end up being the most violent markets in history in terms of volatility. It looks like they already are. This is an unprecedented drop. So I know I say this all the time, just constantly, but this is when you got to have the risk control in place. Now, this doesn't look too bad from this view, right? Oh, this little red squiggly line, but when we're actually in it, it's going to be horrible. I mean, it's already been horrible. This is a solid analysis of what could happen over the next 3 to 6 months, but still, you don't know what's going to happen on the day-to-day, like the actual execution. I don't know either. Nobody knows. But the best traders, the most professional, like Tyler with his vol, they have a specific plan and strategy in place that they're just executing day in and day out. And regardless of what their strategy is, it's cutting off the downside and leaving room for some upside. And the best strategies and systems have been tested through similar periods like this. The way Tyler is able to trade vol is because he's able to go back to 2008, 2000, these other big market drops, 2011 even. And based off that action, he's developed a strategy that works really well now. That's why I'm saying you need something that has been tested over the full cycle. What we're about to see isn't going to be the exact same as what we've seen before, but it might be similar. And either way, if your risk control is solid, it should work through anything. So for me, like you guys know, I use the all-star system, completely different from how Tyler trades vol, but the same in some ways in the sense that there is solid risk management. So we can go to the all-stars in 2008 when the market lost 31% total, and this is the NASDAQ. The all-stars only lost 7%. Huge difference. And you know, if you lose around 7%, it takes 7.5% to get back to break even. If you lose 31%, it takes 45% to get back to break even. Which would you rather have? Clearly the 7%. And then that risk control is why your equity curve becomes so different over time, because you keep cutting off those tail ends where the regular, index does not, this red line. During bull markets, we're all excited about picking the best stocks, but during bear markets and the market like the one we're facing, it becomes all about risk management. You got to be excited about that risk control. It's like the saying, defense wins championships. And if you're going to look at your entire investing career over 40 years, it is going to be that risk control that's going to put you ahead over everyone else. So like for me, the all-stars got me out of the market while the market was crashing. So I'm mostly in cash. Now, I'm not saying it's perfect. Like I'm still in some stocks that are taking some hits, but overall, I'm much better with the system than without it because I got that standardized risk control in place that's been tested back through 2008. And when the market starts turning around and the system is analyzing and the numbers start changing, well, then it's going to put me back into the market and it's going to start testing positions. And yeah, it might be early a few times, but that's investing. The benefit is that if I got in and the market turned again, once again, I got that risk control that's going to save me. And the cool thing about the all-stars is that there's actually 3 ways to use it. There's a monthly model, an active model, and an options model. So the active version is more swing trading, where it gets into a position and then takes profits pretty quickly. And that active model should work pretty well in the type of markets that we're moving into, where it's a bear market where you're going to get massive rallies that are even bigger than the bull market rallies, but then they're going to turn around real quick. So what type of strategy is best in that? Taking your profits quicker. You can't hold for a long trend when there is no long trend. Like right now, that active model is up over 6%, and the general market is down around 20%. So that's a 26% difference between the system and the market. And the beautiful thing is that active model is in all cash right now, 100%. Lots of dry powder ready to be deployed with a full back-tested, thought-out strategy that you can be confident in when you're deploying it. Anyway, that's what I'm telling people when they ask me about this market. It's like, go back to your strategy. And I've said that since I started this channel, even when we were in that raging bull market. And of course, if you want to learn more about the all-stars that I was just talking about, it's open right now, closing Sunday. So there's a link down below in the description and comments where you could learn more. All our fallible people are pretty happy with it because we just get alerts straight to our phone and email, and we just execute based off that. It's a lot less stress, especially in a market like this one. If the model portfolio has not produced a positive return in your year of being a member, then you may request that the next year be free. So low risk to check it out, and potential reward is saving your ass in this crash, just like it saved mine, so I could send it to Tyler in a dirty picture. Check that out, and if you haven't already, make sure you subscribe to this channel, hit that notification bell so you get notifications, because we are covering this market nonstop. This is what we got the research firm for, and I'll keep letting you guys know what's happening, how to look at it. Crazy times, crazy times. Hope you're all surviving in the quarantine. It's not that bad. Alone time is good, right? We still got YouTube. We still got the comment section. You're not alone. Just listen to that Michael Jackson song. But okay, subscribe. I'll see you in the next video. Stay fallible out there. Bye.